You're at an audit committee meeting, suits and ties around the table, coffee cups half empty, and someone asks you, why did the audit plan change after your preliminary analytics? Now, in that moment, you have four ways to respond. Let's walk through them. Option one, you say, our analytics pointed to new risk areas, so we adjusted procedures, timing, and staffing to respond. That's professional. That's risk-based auditing 101. Preliminary analytics aren't just busy work. They're like an early radar scan. If something unexpected pops up, say revenue spikes in a slow month or expense trends don't match the industry, you pivot. You change the plan to target those risks. This answer shows responsiveness, judgment, and that you're tailoring your approach. This is exactly what the committee needs to hear. Option two, you shrug and say, analytics always lead to more testing and higher fees. That makes you sound like a mechanic telling a customer their car always needs extra parts. It's not true, and it paints auditors as fee-hungry. Sometimes analytics confirm your initial risk assessment, and you actually keep testing stable. So this answer is not only unprofessional, it's inaccurate. Option three, you cross your arms and say, can't answer, that's proprietary. Terrible idea. The audit committee isn't a random outsider, they're charged with governance. Your role is to communicate clearly and honestly with them about scope, risks, and changes. Hiding behind a secret sauce excuse damages trust and makes it look like you're covering something up. Option four, you pull out giant spreadsheets and say, here's every sampling table for every transaction class. That's data overload. Audit committees don't want to be buried under technical sampling grids. They want the big picture, what changed, why it matters, and how you're addressing it. Leave the statistical details for your working papers. So, what's the right way? It's option one. Tell them the analytics flagged new risks, and you adjusted the plan accordingly. Procedures, timing, staffing, that shows professionalism, responsiveness, and adherence to standards. Memory hook for exam day. If the question is about explaining audit plan changes, always tie it back to risks. Not money, not secrets, not overload, just risk. Think of it like this. Preliminary analytics are your GPS recalculating route. If traffic pops up on your original path, you don't keep driving blindly, you reroute. That's what auditors do, reroute based on risk signals. Correct answer? 1. Explain that analytics suggested new risk areas. We adjusted procedures, timing, and staffing to respond to those risks. Next question. Which statement is true about acts discreditable? 1. Failing to file a personal tax return on time may be discreditable. 2. Disclosing CPA exam answers to candidates violates the code. 3. Retaining client records after request to coerce payment is discreditable. 4. Using a firm name that implies a partnership when it is a sole proprietorship is acceptable if commonly understood. Here's how I think through it. Number 1. Imagine this. I'm a CPA, but every April 15th, I'm hiding from the taxman like a kid hiding from chores. If I don't file my own return on time, the code says that's discreditable. Why? Because if the tax pro can't handle their own taxes, what does that say to the public? It's like a dentist with cavities everywhere. True. Number 2, disclosing CPA exam answers. That's basically standing outside the testing center whispering, psst, want the answers to regulation? Totally discreditable. The exam is supposed to measure competence, not your skill at sneak and cheat sheets. So yes, this one is true too. Number 3, retaining client records to force payment. Picture me saying, oh, you want your bank statements back? Pay me first. That's hostage accounting, and the code flat out bans it. You return what's the client's, period. Fees are a separate fight. True again. Number 4, using a firm name that implies a partnership when you're really solo. Let's say I'm just Evan, one man with a laptop, but I call myself Evan and Partners. That's not clever branding, that's misleading. The code says firm names cannot be false or deceptive, so this one is false. So, put it all together. 1 true, 2 true, 3 true, 4 false. Correct answer, A, 1, 2, and 3 only. Here's my memory hook. Acts discreditable discreditable are career landmines. Not filing your own taxes? Boom. Leaking CPA exam answers? Boom. Holding client records hostage? Boom. Pretending you've got & co when it's just you and your dog? Boom. If you see those situations on the exam, picture a minefield. Step wrong and kaboom. Independence, credibility, and career all blown up. All right, let's go deeper into this one so you'll have it crystal clear for exam day. The question: which statement is true about review versus compilation? Statement 1: a review provides limited assurance, a compilation provides none. This is true. Under SASR's, Statements on Standards for Accounting and Review Services, here's how the line is drawn. Compilation: I assist management in presenting financial statements, but I do not verify, investigate, or provide any assurance. I don't even need to be independent. My role is essentially, here are your financials, in proper format, based on what you gave me. The report makes clear no assurance is provided. Review: I take it one step up. I perform inquiries and analytical procedures, and my goal is to determine whether I am aware of any material modifications that should be made for the statements to be in conformity with GAAP or the applicable framework. That's what we call limited assurance, sometimes called negative assurance. I don't do tests of details, I don't gain an understanding of internal controls, and I don't assess fraud risk like in an audit, but I do enough to give a small level of confidence. So yes, reviews give limited assurance, compilations give none. Statement 2. Independence is required for both. If impaired for a compilation, disclose in the report. This is false. Review: independence is required. If independence is impaired, I cannot issue a review report, period. Compilation: independence is not required. If I'm not independent, I simply must disclose that lack of independence in the compilation report. I don't have to state why I'm not independent, unless I want to. So the statement is half right, half wrong, which makes it fully false. Correct answer: A, one only. Exam tips. Here's how I remember it. Audit: reasonable assurance. Review: limited assurance, negative form. Compilation: no assurance. Preparation, another SR's S service, also no assurance and no report required unless third-party use. And when it comes to independence, audit must be independent. Review must be independent. Compilation: independence not required, but disclose if impaired. Preparation: independence not required and no disclosure needed. So my mental chant is: audit and review must be independent. Compilation: disclose if not. Preparation: nothing to say. This ties back to why SRs made the 4 buckets of non-audit services so clear: preparation, compilation, review, audit. Each has its own assurance level and independence rule. All right, the next question: a CPA advertises, "We never miss fraud." Which principle/rule is most directly violated? What the AICPA code says about advertising. The AICPA Code of Professional Conduct is very clear. A CPA may advertise services, but ads cannot be false, misleading, or deceptive. That's in the Acts Discreditable and Advertising and Other Forms of Solicitation rule. A claim is misleading if makes unrealistic guarantees, e.g., "we never miss fraud," creates unjustified expectations of success, or implicates abilities beyond what professional standards allow. Now, here's the catch. No professional service, even an audit, is designed to guarantee detection of fraud. Under GAS, the auditor provides reasonable assurance, not absolute assurance. The standards, AUC 240, Consideration of Fraud, emphasize this. Even with a properly performed audit, there's an unavoidable risk that material misstatements due to fraud may not be detected. So when I, as a CPA, advertise "we never miss fraud," I've crossed the line into false and misleading advertising because I've promised something the standards themselves say I cannot deliver. Why the other options are wrong? Independence. That's about objectivity and conflicts of interest. Misleading advertising doesn't directly impair independence. Due care. Due care is about competence and diligence in performing the work. An exaggerated ad doesn't prove I lacked competence, it proves I misrepresented what I can do. Confidential client information, 4, that's about disclosure of private info without client consent. Nothing in this scenario involves client secrets. Correct answer. That leaves 3, advertising, false, misleading, or deceptive claims. This question is sneaky because the substance ties to fraud expectations, but the rule violated ties to advertising. A lot of students pick due care or independence because they're thinking about performance standards instead of communication rules. Remember the fraud expectation gap. Auditors provide reasonable assurance, not a fraud guarantee. Public often expects fraud detection as the main goal. The code is designed to prevent us from feeding that misconception with misleading promises. Quick exam tips. Anytime you see the word guarantee in an audit context, your mind should go straight to that's misleading because assurance is never absolute. Keep the assurance ladder in mind. Audit equals reasonable assurance, not a guarantee. Review equals limited assurance. Compilation equals no assurance. Preparation equals no assurance, no report unless third-party use. On exam day, if an ad says always, never, or guaranteed, the safe bet is false, misleading, or deceptive advertising. Next question. After the report date, but before release, a major customer declares bankruptcy affecting accounts receivable valuation. Which action is appropriate? Option A. Do nothing. The report date has passed. Nope, the report isn't released yet, so I'm still on the hook. The period after the report date and before report release is very much audit time for subsequent events procedures. Think AUC 560 mindset. Doing nothing here is like hearing the fire alarm and turning up your headphones. Option B. Perform subsequent events procedures, discuss adjustment/disclosure with management, and dual date or extend dating as needed. Yes, this is the adult in the room answer. A customer's bankruptcy right after year-end is classic adjusting subsequent event evidence because it confirms a condition that existed at the balance sheet date. The customer's financial trouble didn't magically appear overnight. What I do? Perform subsequent events procedures. Inquiries, read minutes, updated lawyer letters if needed, scan post-BS transactions, etc., through the new date that covers this event. Discuss with management. This typically requires adjusting the AR, allowance/write-off, and appropriate disclosure. Date the report. Either dual date, example, March 31, 20x6, except for note X, as to which the date is April 10, 20x6, to limit responsibility to this one event. Or extend the report date, single later date, which makes me responsible for subsequent events, procedures through that later date for all subsequent events. Choose your adventure wisely. Dual dating equals surgical, extending equals full checkup. Update written representations from management through the new date I'm taking responsibility for. Communicate with those charged with governance, audit committee/board, nature of the event, the planned adjustment, disclosure, and the dating approach. Option C, withdraw. The event invalidates the audit. Too dramatic. This isn't a flip the table moment. It's a adjust and disclose moment. I don't withdraw unless management refuses to correct material misstatements or there are broader integrity issues. Option D, issue a new report without discussing with governance? Nope, this is material and governance deserves and expects a clear heads up. Silent Ninja Auditor is not a recognized role. Why this is an adjusting event, helpful mental model. Adjusting events. Provide evidence about conditions that existed at the balance sheet date. Example, post-year-end bankruptcy confirming pre-existing financial distress. Adjust the FS, AR allowance/write-off, and disclose as needed. Non-adjusting events, conditions arose after balance sheet date. Example, a fire destroying a plant next month. Disclose, don't adjust, unless going concern implications get spicy. Practical steps I tick off, so I don't forget. 1. Rerun subsequent events procedures targeted to AR and that customer. 2. Get updated aging/cash receipts. Evaluate collectability, revise allowance. 3. Ensure footnote clearly describes the bankruptcy and impact. 4. Dual date, usually my preferred route, or extend the date, document the rationale. 5. Refresh representation letter to the new date. 6. Tell governance what changed, why, and how we addressed it. Exam tips that save points. Before release equals subsequent events procedures. You're still in the game. After release equals subsequently discovered facts world, different playbook. Assess reliability, discuss with management, possibly reissue, notify users. Bankruptcy of a big customer after year-end, your reflex should be adjusting event, confirming pre-existing condition. Dual dating versus extending. Dual dating equals narrow responsibility to that event. Extending, you're now responsible for all events up to the new date. Choose like a person who enjoys sleeping at night. If a whale customer goes bankrupt and your AR still shows their balance smiling back at you, that's not a maybe later issue, it's an adjust now issue. Think of dual dating as adding a precise postscript, not rewriting the whole novel. Correct answer? Option B. The question is asking which statements about group audits are true. Statement 1. The group auditor is responsible for direction and supervision of component auditors. That's true. If I'm the group auditor, I'm still the one in charge. I can use other auditors, but I can't hand off responsibility. Statement 2. The group auditor may refer to component auditors in the report to divide responsibility. That's false. Under AUC 600 and ISA 600, the group auditor takes full responsibility for the opinion. No dividing responsibility in the report. Only PCAOB standards allow that in certain issuer audits. Statement 3. Understanding the component's environment and materiality is necessary to plan the group audit. That's true. I have to understand the component's business and risks, and I need to set materiality at the component level. Statement 4. The group auditor can rely on component auditors without evaluating their competence. That's false. I must evaluate the component auditor's competence and independence before relying on their work. So the correct answer is Statement 1 and Statement 3 only. Answer, Option A. I remind myself with 4 points. 1. Captain of the ship. I'm always responsible. 2. No split opinions. I don't divide responsibility in my report. 3. Know the terrain. I understand component environments and set materiality. 4. Trust but verify. I check the competence and independence of component auditors before relying on them. If I keep those 4 in my head, I can tackle any group audit question with confidence. Next question. Which is most appropriate when a scope limitation is imposed and alternative procedures cannot be performed? Option A, issue an unmodified opinion with an emphasis of matter paragraph. This is not correct. An unmodified opinion means I obtained sufficient appropriate audit evidence and everything is presented fairly. But here I'm literally missing evidence because of a scope limitation. An emphasis of matter is only used to highlight something that is already appropriately presented or disclosed, for example, going concern uncertainty or a significant subsequent event. It cannot be used as a patch when I fail to gather evidence, so option A is out. Option B, issue a qualified opinion or disclaimer depending on materiality and pervasiveness. This is the correct choice. Let me break it down. If the evidence I'm missing is material but not pervasive, I go with a qualified opinion. That's the classic, except for the possible effects of wording. If the limitation is both material and pervasive, I have to step back and issue a disclaimer of opinion, meaning I can't express an opinion at all. This treatment comes directly from the reporting standards, AUC 705/ISA 705. The key decision hinges on materiality and pervasiveness. Option C, withdraw. An opinion is always impossible under limitations. This sounds dramatic, but it's not right. Withdrawal is not automatic when there's a scope limitation. If management intentionally blocks me from obtaining evidence and the effect is pervasive, then withdrawal may be considered, especially if I can't disclaim properly. But in the standard exam setting, I don't jump straight to withdrawal. Option D, issue an adverse opinion. Nope. Adverse opinions are for situations where I obtained evidence and concluded the statements are materially misstated. A scope limitation is different. It's about not having enough evidence, not about finding misstatements. So adverse doesn't fit here. Okay, correct answer, option B. Issue a qualified opinion or a disclaimer depending on materiality and pervasiveness. All right, let's tackle this objectivity question together. Statement 1 says, objectivity applies to all CPAs, including those in business, not just in public practice. That's true. The AICPA code treats objectivity as a bedrock principle. It doesn't matter if I'm a partner in a big audit firm or if I'm the CFO of a manufacturing company. I have to be fair-minded and avoid bias in my professional judgment. So statement 1 is solid. Statement 2 says, a financial interest always impairs objectivity. This one trips people up. Independence and objectivity aren't the same. Independence rules are very strict for auditors. Even a small direct financial interest can impair independence. But for objectivity, it's not always. The question is, does that financial interest actually bias my judgment? Saying always impairs goes too far. So statement 2 is false. Statement 3 says conflicts of interest can impair objectivity if not disclosed and managed. Yes, this is true. Picture me advising 2 clients on opposite sides of a merger. I can't possibly be objective unless both sides know and give consent, and I have safeguards in place. If I don't disclose and manage it, my objectivity is out the window. So when I put it all together, the correct ones are statement 1 and statement 3. Answer, option B. Here's how I lock it in for the exam. I tell myself, objectivity equals for every CPA, not just auditors, financial interest. It's not an automatic killer for objectivity, but it is for independence. Conflicts of interest? If I don't disclose and manage, objectivity is impaired. That way, when I see the word objectivity, I instantly think broad principle, conflict-driven, not automatically blown up by every investment. The next question is, which tax service is ordinarily permitted for an issuer audit client if pre-approved by the audit committee? Option A. Advocating in a tax court proceeding on a contingent fee basis. Nope. Contingent fees are a hard stop. And if I'm up in court waving the client's flag, that's an advocacy threat that violates SEC and PCAOB independence rules. Option B. Planning and compliance that do not involve aggressive tax shelters or contingent fees. Yes, this one works. Tax compliance and routine planning are allowed services if the audit committee pre-approves them, and as long as I avoid contingent fees and prohibited tax shelters. This is the safe lane under SEC Rule 201 and PCAOB standards. Option C, preparation of personal returns for the CFO while the audit is ongoing. That's a problem. I can't do personal tax services for senior financial officers like the CEO, CFO, or equivalent. That's off the table, even if pre-approved. Option D, designing and implementing the client's tax accounting system? Nope. Designing or implementing systems is considered management's role and creates a self-review threat. That's prohibited for audit clients. So the correct answer is A, option B, planning and compliance that do not involve aggressive tax shelters or contingent fees. Quick recap. For issuer audit clients, the only tax services I can do are the boring ones, compliance and straightforward planning, and only if the audit committee signs off. Anything flashy like contingent fees, tax shelters, personal services for top brass, or system design is out. All right, future CPAs, let's talk about what I actually have to communicate to those charged with governance. Think of governance like the board of directors sitting at the dinner table. What do I, the auditor, have to bring to the table? Statement 1. Significant uncorrected misstatements must be communicated. Oh yes, if management left a pile of misstatements sitting in the corner like dirty laundry, I've got to point it out to governance. They can't oversee properly if they don't know what's uncorrected. Statement 2. The auditor must communicate the planned scope and timing when those charged with governance requested. Yep. If governance asks me, so when are you showing up and what's your general plan? I don't hand them my 30-page audit program, but I do give them the big picture, overall scope and timing. Think of it as giving them the movie trailer, not the entire script. Statement 3. The auditor must provide all raw data and analytics scripts used in planning. Now, that's a no. They don't need my secret sauce recipe. Governance wants the meal, not to watch me chopping onions in the kitchen. My working papers, raw data, and scripts, those stay with me. Statement 4. Independence must be communicated. Yes, this one's non-negotiable. I need to look them in the eye and say, yes, I'm independent, or disclose any relationships that might bear on independence. That's like promising you didn't eat dessert before dinner. So which ones are true? Statement 1, Statement 2, and Statement 4. Correct answer, option A. Here's how I keep it straight in my head. Governance wants the important stuff, not the clutter. I tell them about uncorrected misstatements, dirty laundry, the scope and timing, the movie trailer, and independence, the promise I didn't sneak dessert. But I don't dump my raw data on the table. That stays in the kitchen. That way, when the exam throws this at me, I can laugh, picture the dinner table, and pick the right answer without hesitation.